Well, if you work at any kind of corporation, you have probably done some kind of training video at some point. And our next guest company is responsible for many of those. So I guess you can thank him or blame him depending on how you feel about the video. Skillsoft CEO Jeffery Tarr is with us. The company just went public through a SPAC deal and begins trading today. But Jeff, I should say, you guys don't just do sort of compliance videos and such, you do upskilling videos as well. And I'm curious, since that has been a hot topic, sort of what the divide is, how much of what you do is the sort of compliance stuff and how much of it is a push by companies to upskill and therefore improve their workforce or even get new workers in who can then learn new skills?
Super. Thank you for that question. We cover all the major categories of corporate digital learning. So that includes leadership and business business skills, compliance, and technology training. And a lot of it is not just push, it's actually pull from the learners. The learners want to learn, they want to advance their careers. So it's both push from the employer, pull from the learners, and it really is a growth opportunity.
Jeff, how are you going to design videos or training videos differently as we all return to work? I mean, you have a workforce coming back to the office that has spent over a year learning new skills at their house, and they really don't necessarily want to hear from their boss.
Well, Skillsoft is designed for the way people learn online today. So these aren't 45-minute lectures that are just filmed in classrooms and dropped online. These are 2, 3, 4-minute bites of learning that are linked together in what we call Aspire learning journeys, interspersed with assessments and with badges. So it's a highly interactive experience that is designed for the way people learn, and it's actually quite addictive. And when it comes to learning, addiction is a good thing.
You know, Jeff, I'm curious for your read on where corporate America is in their investment cycle, because I'm looking at your presentation and maybe there's updated numbers I haven't seen, but combined order intake from 2019, you're not expecting to get to those levels until the end of next year and maybe even a little bit below, depending on where that guidance range is actually a little below. I'm just curious how much reticence you've seen from some of your customers to really invest in these projects, as there's still a little bit of trepidation around where the cycle might go.
Well, we're actually seeing tremendous adoption. Most of our revenue now is on a growth business, which is our new product called Percipio, and on our digital learning. So we're seeing tremendous growth on that portion of our revenue. And that is because there's a huge shift from classroom first to digital first in corporate digital learning.
Jeff, not so often you see on a presentation release a company noting they see 1,000 possible tuck-in acquisitions. What would some of those acquisitions be in what sector?
Well, there's a lot of innovation taking place in corporate digital learning. Content assets, so learning content, learning technology in areas like adaptive learning or delivering coaching online. And then there are new verticals and new geographies that are adapting corporate digital learning. And we have a platform that is designed to integrate third-party content and distribute it to our customer base, which includes 70% of the Fortune 1000. So that allows us to acquire these smaller companies that don't have distribution, put them on our platform, drive growth in a highly accretive fashion, and deliver value to our customers who really need a company like Skillsoft to help make sense of the chaos out there and extend our one-stop shop into new areas.
Interesting. Well, we'll keep in touch as you embark on that journey and as you do some of those acquisitions. Jeffery Tarr is the CEO of Skillsoft. Thanks so much, Jeff. Appreciate it. Well, on Friday, the House of Representatives saw the introduction of a host of new bills aimed at reining in large tech companies. And they did that in a number of different ways, including try to propose divestment of certain assets. Sinan Aral is joining us now. He has paid a lot of attention to these issues. He's the author of The Hype Machine about social media companies. And he's also the David Austin Professor of Management at the MIT Sloan School of management. It's good to see you, Sinan. So, we've had this conversation a number of times, right, about Congress's attempts to rein in big tech, and so far, their inability to do so. Do any of these bills get closer to being better targeted at all of these big questions?
Well, I mean, I think these are important steps forward. We'll see whether these are passed and made into legislation. Obviously, they have bipartisan support. There are some Republican signatories to these bills. 5 different bills. One of them is about not being able to favor your own products and services if you run the platform or the market that sells them. Another one raises the bar to prove that a merger isn't anti-competitive. Another one increases fees for mergers to fund enforcement. These are all important steps forward and hopefully will open the door to creating more competition and innovation in the social economy and in the digital economy.
Sinan, under what is being proposed, does big tech have to spin off or sell off any key assets?
No, not yet. So there is a bill that makes it easier to break up a company if there's what is called a conflict of interest. But I don't think that this is necessary, and I don't even think that this is going to sort of result in major divestitures of these assets. I think that what we actually need to create competition and innovation is structural reform of these economies, and that's really what these bills are aimed at. However, I think there's a glaring lack of a focus on interoperability legislation, which is a big miss. I think if we had that, it would be probably the number one best alternative to create innovation and competition, especially in the social media economy for Facebook and the others. But these are important steps forward. It signals a change from what used to be a very pro-business stance on competition and anti-monopoly over the last 30 years in the Chicago School. And I think that it's important to create competition and innovation.
So I think I could guess at what exactly that interoperability kind of dynamic you're talking about is, but I'd love if you could just outline for us a little bit of what that means for users, normal people as they think about their use of these platforms and what that would look like if some of these, kind of ideas came through.
Yeah, interoperability just means that I can use one service with the other. So I can imagine if you couldn't send a text message from Verizon to Sprint. You would think that's ridiculous, but right now we can't send messages from Facebook to Twitter or from Instagram to Snapchat, and that creates more ability for monopolies to retain their power. If there was interoperability, it would create competition. When we had the AOL Time Warner merger, AOL Instant Messenger was forced to become interoperable with Yahoo Messenger and MSN. It went from 59% market share the year the legislation was enacted to 55%, and then it ceded the entire market to new entrants 3 years later. What would this look like? Well, right now, all of the platforms have very similar messaging protocols. You have fleets and stories, you have text-based messaging, you have video-based messaging. It would just mean that you could send messages from one platform to another, and the critical thing that enables is choice. I can then choose which platform I want to be on to send messages to any other platform. That's where the competition comes from.
And Sinan, I'm guessing you would also be in favor of sort of opening up the App Store, which has been something that, of course, has been in focus for Apple in various quarters, that they should maybe not make it as onerous as critics have said it is to put stuff on the App Store to not advantage certain things, et cetera.
In this digital age, things like the App Store are a massive part of commerce. And I like what Elizabeth Warren said about this. You can't be the umpire and a team in the same game. I shouldn't be able to set the rules of competition and then compete by providing my own products and services while giving preferential treatment, say, to Amazon Basic products or to Apple apps in the App Store. And I think it should be a little bit easier and less financially onerous to be part of the competitive landscape on a digital marketplace like the App Store or on Amazon. That would create opportunities for small and medium-sized businesses to compete. That would generate competition. It would generate innovation. All of that would be good for the entire economy.
Finally, Sinan, I do want to ask you about another story that came out in the past week that I wonder if you have a view on. And it has to do with the release of subpoenaed information from the US government. In this case, Apple releasing some personal information that was subpoenaed. And it turns out it was for members of Congress and other folks that were high profile. So this is it's a tricky situation for these tech companies. How do you think that kind of situation should be approached?
These subpoenas should never have been issued, is my opinion on that. I think that there was a tremendous amount of government overreach in trying to investigate and infiltrate, Don McGahn and other types of lawyers for the White House and other, political officials and so on. This is not something that you expect to see in the United States. This is something that you might cringe at if you saw it in another country. And I think that, my basic position is that these subpoenas shouldn't have been issued in the first place.
Fair enough. All right, Sinan, great to see you as always. We'll talk to you soon. Sinan Aral, author of The Hype Machine and a professor, the David Austin Professor of Management at the MIT School of Management.
Online grocery retailer Boxed is announcing it's going public through a merger with blank check firm Seven Oaks Acquisition Corp. That announcement today, with the deal valued at $900 million, brings in, or at least provides Boxed with roughly $334 million in net cash proceeds. Let's bring in Chieh Huang, the CEO of Boxed. And Chieh, certainly a very exciting day for you. I know you're joining us from New Jersey, where it all started. But talk to me why you decided to go through a SPAC, because this really comes at a time when there is more and more scrutiny on these mergers, especially coming from the SEC. Why did you decide to go forward in this way?
Yeah, absolutely. So two main reasons, Akiko. One is the quantum of capital that we can raise. So as you mentioned before, depending on the final vote, we'll get roughly, if all goes well, over $300 million to our balance sheet. So that quantum of capital is very difficult to raise, given our market cap, if we went the traditional IPO route. Second has been really being able to tell our story. So, of course, most folks out there know us for our B2C business. But really, as we're releasing the data now, a big portion of our business is B2B. So servicing small to medium-sized enterprises, Fortune 500 companies all around the country. That business got really, really hit last year because of COVID. And to be able to tell that story of what it looks like going forward has been really the reason why we chose SPAC. The other part of B2B and the other part of our story that we want to tell that we couldn't tell with an S1 was how we're beginning to sell the software that powers Boxed. And so all those reasons combined pushed us towards choosing the SPAC instrument.
Yeah, I mean, we've been talking for years now. I mean, you've been on the show with us here at Yahoo Finance multiple times over this. You guys have been doing this for 8 years. So to see exit value here, valuation around $900 million is a lot in 8 years' time. But talk to me about that B2B side, because we had discussed kind of your partnerships in Asia there as a reason for acceleration, what you saw in growth ahead. So I mean, how big has it been for you, and what do you see in kind of that next step as you lean into that side of the business?
Yeah, so on B2B here in the US, we do feel like we're about to enter one of the most prolific back to school, back to work periods in modern American history, perhaps even American history in general. And so servicing kind of businesses here, both small and large, with pantry snacks, with things that they need to power their business from a consumables perspective is something we're really looking forward to. Now, internationally, we're also not just selling snacks, or we're not selling snacks internationally, we're selling the software. And so partnering with folks like Eon is going to be really huge for us. So, in our forecasts, you're going to see that we're forecasting a good amount of revenue, even this first year in selling revenue. We're forecasting out 8 figures of revenue this year. And we think it's going to be a compelling value for investors who see the future, that e-commerce is not slowing down, and e-commerce enablers are certainly seeing a lot of tailwinds as we exit COVID.
What kind of pickup have you seen in Asia? Obviously, that partnership with Aeon is certainly a big one, but as you look at potential growth prospects and the recovery that's happening in the region, what are you seeing on your front?
I'm seeing a lot of potential because if you think about it, we don't talk too much about even something like Southeast Asia here in the U.S. But if you combine something like Vietnam and in Indonesia, those two countries combined have more people than the U.S. And so those folks are digitally savvy. They're beginning to buy things online. Of course, now there's heavy lockdowns because of COVID. But as we begin to launch our projects there, you're going to see us really capitalize on those tailwinds.
Chieh Huang, always good to talk to you. Box CEO joining us on the back of their big SPAC merger announcement. The growth in e-commerce has led to a big boom for startup Printful. The printing on-demand company saw an 80% pop in revenue last year. Recently raised $130 million as well. The company, we should point out, allows customers to print everything from t-shirts to home decor, as well as promotional gear. And we are joined by the CEO of Printful, Davis Siksnans. Davis, it's good to talk to you today. Certainly a lot of growth over the last year as you have integrated with the likes of Shopify as well as Etsy. What's the outlook look like for you right now?
It looks good. I mean, the last year was exceptional, but this year we're expanding the capacity. Actually in our business, which deals with physical stuff, we couldn't meet all the demand we saw last year. So this year we're actually trying to double up our capacity by launching new facilities in California, Texas, and in Europe and UK to sort of address all that pent-up demand that exists.
No, it's a phenomenal business. I've used it before through Shopify, and it's really easy to upload your designs and have everything handled on the back end to just say, all right, we're going to have them. Printful's going to ship it out, print everything. It's all going to be handled. When you look at people using it, though, what are you seeing in terms of return rates and people actually continuing to use Printful? Because I would imagine some people might turn to you to get a business off the ground, but then if they get large enough, they might want to bring that production in-house. Or maybe if they just don't succeed, they would just want to stop altogether. So, I mean, what are you seeing in terms of how many people turn to you guys and then also stay working with you over the longer term?
There's no doubt that launching an online business and building it into a sustainable business is really hard. But actually, most people tend to stay with us because, it's not only that would be very difficult to build out the capacity. We invested almost $50 million. So, not all businesses who do apparel can invest that money, but they can continue to scale with us, and actually most of them do. But our business, we just want to offer them more services. So recently we launched more custom branding options. So the business who want to offer things like custom packaging can do that with Printful, and they don't have to look elsewhere for help.
So if we're talking about something like an 80% pop in revenue from last year, how sustainable are those kind of levels?
Well, it's definitely a COVID bump, right? And our partners as well as like Shopify and Etsy are reporting yes, the last year was exceptional. This year is going to be softening. It's very difficult to predict, but this year's going to be, but it's going to be elevated levels as well. And, it's not going to be 80% likely, but it's going to be more than 2 years ago.
Yeah, when it comes to what platforms you're seeing the best growth on, I mean, we talk so much about Shopify and the way that you guys have integrated there, but Etsy as well. I mean, is there one that really stands out right now as one that's not giving up that COVID bump as things reopen that you're still seeing engagement on?
I think Shopify is still the leader. We saw a phenomenal success on marketplaces, especially Etsy. And Etsy was for quite a bit known last year that is where you went to shop for handmade face coverings. All the demand for face coverings have really come down, but a lot of those people who started selling face coverings, and that was sort of their first steps into online e-commerce, now have switched and expanded into new other products. And they are selling, with us, it's t-shirts and phone cases and other products, but they are trying out all kinds of things over the e-commerce. But we're seeing really good results with Shopify now.
Yeah, it's pretty impressive the way you can build that out and just go from one design to having all these things printed and handled and shipped. But appreciate you coming on here to give us the update. Keep us posted as we move farther and farther along. Davis Siksnans, Printful CEO. Appreciate you taking the time here with us today. Well, another vaccine has demonstrated its worthiness to be added to the global arsenal being used to fight the pandemic. This time, Novavax, saying its vaccine proved to be more than 90% effective against the virus in a nearly 30,000 person trial. It was also shown to be 100% effective at preventing moderate or severe disease. And for more on its path forward to getting into the arms of patients around the globe, happy to bring on the CEO and president of Novavax, Stanley Erck, alongside Yahoo Finance's Anjalee Khemlani with us as well. Mr. Erck, appreciate you taking the time here to chat. I mean, when we look at this, obviously here in the U.S., there's a bevy of vaccines here available to us. But when you look around the globe, where are you seeing the biggest impact that Novavax can have with this one from the get-go?
Yeah, so a good question. So in the U.S., so we ran the trial in the U.S., and what's interesting and what will be helpful globally is the fact that in this trial, although we got overall 90% efficacy, and 82% of the people they got sick from variants, and everybody's heard about variants and are worried about them. And since we ran the trial during the period in which variants were circulating, we were able to show efficacy against that. We got 93% efficacy against the variants of what they call variants of concern or variants of interest. And in addition, the vaccine that was circulating that's more like the original Wuhan strain, we've got 100% efficacy. So a great place to start. And so what does it mean for us for global distribution? So we've taken the position over the last year that we want to get the vaccine out globally, and that includes more than just the U.S. and Europe, but to low and middle income countries. And we've done that. We formed a partnership a year ago with the Serum Institute of India, which is the largest vaccine manufacturer in the world. They supply 65% of the children of the world vaccines and childhood vaccines, and so we partnered up with them because they know how to get vaccine into what are called the 92 AMC countries, which are the middle and low income countries. And so between us, we have pledged 1.1 billion doses of vaccine that will go to what's called the COVAX facility. It's the facility that the U.S. government just announced that they were giving 1 billion doses to. So we will supply them 1.1 billion doses. So most of our vaccine will go to low and middle income countries, which are desperately needed there. And then on top of that, we have advanced purchase orders from high income countries in a couple 100 million doses, and we'll get to those as well, starting in the fourth quarter or beyond. But it's big impact early on is going to be ex-U.S. And then ultimately, the big impact in the U.S. is going to be, I think, will be focused on using our vaccine as a booster next year, because everybody will need boosters.
Stan, I absolutely wanted to ask you about that. But first, let's focus on the ex-US, which is that focus for those 92 countries. You mentioned your partner, the Serum Institute. We saw how that partnership worked out for AstraZeneca and Oxford earlier on, because it's continuing to be such a dire situation there. Do you see your vaccine playing a role and maybe falling under some of those same domestic pressures to circulate the vaccine in there first?
Sure. And so we have discussions going on with the Indian government, because we want to have our vaccine that's made there shipped inside India, but also to support this COVAX commitment we have of $1.1 billion. And I believe that the Indian government is going to allow us to not only make the product in India, for India, but for the COVAX facility and for all of our commitments. And so we have plants in the Czech Republic and in Spain and in the U.S. and Korea, where we can make product there for our COVAX. So it's quite an extensive network.
Well, and so let's bring it back to the U.S. I know you mentioned the booster market, and that's obviously a key market for pretty much any vaccine maker that gets authorized this year. But looking beyond that, there is still a large portion of the U.S., certainly in pockets where there has been hesitancy about the newness of the mRNA platform, or hesitancy over the concerns with the Johnson & Johnson vaccine. Do you see Novavax playing a role filling in there, or are you facing some of the same hesitancy issues?
No, I think I think that there will be a pocket. There is a pocket of people who are waiting for a vaccine that has the more traditional approach of a protein-based vaccine like we're using, and so when we get that approved, we'll be able to fill that demand.
And Stanley, following up on Anjalee's question there on the booster shots, a lot of questions right now about just how long the efficacy will last for those of us who have already been vaccinated. What does the booster market look like in the U.S. here? In looking months down the line, what does the fall look like in terms of the amount of those who are vaccinated and the additional booster shots that will be needed?
Yeah, I think, we don't know. The answer is we don't know everything yet because there's not enough time that's passed. But I think it's clear that we all have antibodies that decline over time because all vaccines do. And whether it's 6 months or a year, that it looks like the level has gone down enough that we can boost. We have boosted. Both in our non-human primate study that we started a year ago and vaccinated baboons and saw their antibody levels go very low, and then we boosted it a year later. They got tremendous responses, way higher than they got the first 2 doses. So it works. And so whether you have to have a boost every year or whether it's every 2 or 5 years, we'll find out over time. But I think it's going to be important for boosting.
Stan, talk to me about the manufacturing. I know that you've committed to the capacity of 150 million doses per month by the end of the year. Has anything changed in the past couple of months as we've seen different companies sort of branch out, in terms of delivering to various to various countries? Has the pressure on the supply chain decreased at all, or has it maintained?
No, I think that's a good point. We've been constrained for the past 6 months off and on by, we can't get some raw material, we can't get a depth filter that you need to filter the product in the manufacturing process, or you can't get 2,000-liter plastic bags to grow it in, and some really dramatic shortages. That's starting to even out. We what you would love to have in all of our 8 plants is 6 months of inventory of all the stuff, and we don't. We have weeks in some cases, and we have months in others, but it's getting better. And our expectations, and when we make this forecast that we can have 150 million doses running through our plants every month, we're expecting that we'll have the raw material supply straightened out by then. So we're pretty confident about that.
Yeah, and Stanley, just to wrap up here, when we talk about how it fits into your guys' role in this pandemic, thinking back to where it all began, there were some people, I don't want to say they were haters on Novavax, but doubters out there that you guys could get here. Now you prove them wrong. When it comes to your guys' payback on that and what you're trying to do, low and income countries doesn't sound like there's a lot of profitability opportunity around that. But how are you looking at it from your standpoint in a business perspective, and how profitable this is going to be for you guys if you are going to play that, and what boosters might do to maybe play a factor in that as well?
I think the problem gets solved when we show that we have a best-in-class vaccine, and if we start selling in the low-income countries first, so be it, and so the profits will come bigger later. But I think we've shown now that we have the potential to be widely called the best-in-class vaccine, and that's what we intend to develop over the long run.
Stanley Erck, Novavax CEO and President, appreciate you taking the time here to chat with us alongside Yahoo Finance's Anjalee Khemlani.
Switching now to politics and big tech. Looks like lawmakers are definitely taking aim at big tech. A bipartisan group of House lawmakers introduced 5 bills last week targeting Amazon, Facebook, Google, and Apple. Here to talk about it is Charlotte Slayman, Policy Director at Public Knowledge Competition. Charlotte, thanks for being here. So before we really delve in, why don't we just break down, for people who don't know and don't read the legislation on the books, what those 5 bills, if they do indeed become law, what might they do to those big tech companies? How might they regulate them or restrict what they can do?
Great. Yeah, so the first bill is just giving more funding to the antitrust enforcement agencies, the FTC and DOJ. Next, it's going to require that they offer interoperability. So it's not something they have to stop doing. They have to start offering interoperability to their competitors and potential competitors. They will have to stop anti-competitive discrimination against competitors and potential competitors, and they'll be very limited in the types of acquisitions that they could do. The last is a tool for the antitrust enforcement agencies to put line of business restrictions when there is a conflict of interest, so that a company can't own 2 businesses where there's a conflict of interest.
Now, the FTC and other regulatory agencies have been fairly toothless, I should say, in the past in terms of regulating some of these big tech companies and then punishing them if they do decide that they have overstepped. How much do these bills really go to give those agencies the power to effectively, regulate some of these big tech companies? And what more power do you think that they might need going forward?
Yes, this will make a big difference for the antitrust agency's ability to address the problems that we're concerned about with these companies. I think there have been serious limitations to how antitrust law can address the power of these companies because of particular ways that platform markets operate. It's been really difficult for antitrust enforcers to identify what are the potential competitors that are going to really pose an issue here. And so some mergers have been let through, some conduct has been allowed that I think would have been really difficult to stop in the courts given current law. So having these new laws that are focused just on these companies will really allow the agencies to open up these markets for competition, which I think is what we absolutely need.
Do you think that down the road, and possibly even on President Biden's watch, we could see one of those big tech companies actually get broken up?
Yes, it could happen. There are these other tools that I think enforcers would probably use first. But I think there absolutely may be situations where non-discrimination is not sufficient and those conflicts of interest are really pernicious and a company may need to be broken up. So this legislation would give enforcers that tool.
Now, Charlotte, some of these antitrust bills, just as a historical lesson, some of the antitrust bills that were aimed back at Microsoft back in the 90s actually enabled some of the companies that we're talking about right now to really rise and grow and become as huge as they are. Are there any concerns at all about the broader impact, especially decades from now, that some of these bills might have?
So I think your example is a great one, right? It shows the power that pro-competition laws can have. If these laws are successful, I really think in the future we'll see more competition, more innovation, and hopefully we'll see some different companies bringing a great idea to market that today is too difficult because of the powerful position of these platforms.
How comprehensive, though, do you think these 5 bills are? Are there areas that they are just not touching on, that they're ignoring, things that you would have liked to see included in these bills?
Well, they are quite comprehensive, but I do think the next step will be to create a new agency that is focused on dominant digital platforms that can take care of some of the other concerns that we have. Privacy, in particular, comes to mind, an area that we've been really hoping that Congress will legislate. I think that competition can really help with some of those problems, but that we are also going to need additional legislation, something focused on privacy, and also having a new agency that can more comprehensively regulate these firms. Those are sort of the next steps that we're looking forward to after this legislation.
Let's talk some of the criticisms of these bills, namely from the companies, particularly ones like Amazon, for example. They keep saying that these bills are essentially going to negatively impact consumers, that we're going to see prices rise on platforms, for example, like Amazon. What do you say to some of those criticisms that these bills are actually, in the long run, going to negatively harm folks like you, myself, Alexis, and others that are going shopping online or, using Facebook to connect with family and friends?
Right. I don't think that's right at all. I think what we are seeing right now is an environment where there is very little competition against these companies. And so they are able to do what is best for them instead of what is best for consumers. What these bills are really targeted at is opening up competition so that consumers will have a choice. And if you see a better price somewhere else, that there would be an alternative for you to go to. Or more importantly, if you're unhappy with the policies that the company is using, if you're not happy with how Facebook is treating your privacy, or if you're not happy with how Facebook is treating misinformation, you could choose an alternative. You would have an alternative that you could go to without the difficulties, what we call barriers to entry that companies are facing right now with trying to get started in these really difficult markets.
I want to go back to the notion of one of those or more of those tech giants being broken up. Who do you think we might see that happen to? Remember Microsoft, the government tried to break up Microsoft years ago, and that really went nowhere. So is it feasible? And if so, for which company?
Right. So that's why we need new laws, right? I think the Microsoft example, again, is a great example. Another one that we think about is the breakup of the Bell system in AT&T much longer ago. It required a lot of action from an agency. It required action from Congress to really make that happen. And so that's, the first step of, I think, what's happening here. In terms of which company may be broken up, I think it really remains to be seen, right? There are these other tools that are also being given to the agencies that they're going to start with and see how that goes, see if non-discrimination is able to address these problems. When we find out the areas that are not being sufficiently addressed by the new laws, I think that's really the place where one of these breakups would be necessary.
I want to just quickly ask you, before we let you go, what you estimate is really the likelihood right now, and I know there's been some bipartisan support for some of these bills, but the actual likelihood that the full slate of bills is actually going to get passed?
Well, it's always difficult to pass legislation, so let's start with that. But really, in the sort of scheme of what might pass through Congress, the fact that these are bipartisan bills and the fact that they come from the chairman and the ranking member of the relevant subcommittee, the Antitrust subcommittee, is a really good sign for their ability to pass. So I think people really need to take these seriously. There is a good chance that they could pass. And it's really going to change the conversation moving forward, that these ideas have so much bipartisan support from such serious members of Congress.
All right, we're going to leave it there, to be continued for sure. Charlotte Slayman of Public Knowledge Competition, thank you.
Welcome back. Well, as the economy continues to recover, foot traffic to places like Starbucks and Dunkin' Donuts is on the rise. So what does this say about the state of the economic recovery? Well, we're joined now by Ethan Chernovsky, Chief Marketing Officer at Placer.ai, and Yahoo Finance's Brooke DePalma. Thank you both for joining us for this conversation. So Ethan, just based on the foot traffic data that you guys have been seeing, how optimistic are you about the recovery at this stage?
I think at this stage, there's just ample reason for lots of optimism for a few reasons. First, we're seeing visits come back at a really strong level across the country. But even more, that's happening while California and New York are still trailing far behind because of the pace of their reopenings. So when you think of how many retail locations for brands like Starbucks and other retailers that we have in those states, there's actually room for another surge to come in June, July, ahead of a really critical back-to-school season.
And Ethan, over this past year, many large fast food giants like McDonald's, like Burger King, have really put their best foot forward and invested in digital. So as people return to those indoor dining rooms, how will digital play a role in that?
So I think it's about omni-channel. And I know this is kind of the buzzword of the space for a long time now, but we got this great opportunity for brands to really focus on how can they meet the customer where they want to be met. And this means having, really strong delivery, drive-through, takeaway options, but it also means having a really strong presence in the location. When we think about the rise of work from home and what that could mean for people who want to get out of the house for an hour or two in the middle of the day, and how that Starbucks can become a great extra workspace, the in-store growth of the omni-channel piece is just as important as the digital side.
And the elephant in the room right now with the fast food industry is really supply chain issues that are becoming apparent during this time as people migrated during the pandemic and these local Starbucks, Dunkin' restaurants just can't keep up. So where exactly are you seeing that happen? And what's your recommendation for fast food to really keep up with that migration trend?
So I think the starting point is recognizing that the fact that there's a supply chain issue, which we knew was going to be somewhat of a problem because of the global nature of this pandemic, But the reality is there's a recovery happening, and demand has proved to be incredibly resilient when that wasn't necessarily what many expected in the height of the pandemic. So the first step is to realize, wow, things are in a really good position. The second is there's been a lot of change because of the pandemic. Like you mentioned, migration patterns, people leaving major cities and going into other cities like Raleigh, North Carolina, or Austin, Texas, or Phoenix, Arizona. And the fact that that's going to shift demand to other locations. So there's going to be a lot of work done by these brands to understand how their audiences have shifted and how they need to adapt their footprint to reach a changed ecosystem.
You know, Ethan, going back to your survey, what were some of the themes that you saw or the patterns that you saw then when it came to foot traffic sort of rebounding from where it was at the height of the pandemic?
So the interesting thing is, throughout the pandemic, we saw some sectors that were just doing better than others. And so grocery and home improvement, these were strong performers that benefited from essential retail status and benefited from a really strong alignment with key retail trends. But other sectors, there was a much more downcast approach. So a brand like Panera or other sit-down restaurants, or even an in-store focus for a brand like Starbucks, there wasn't necessarily this expectation of strong return. Yet that's exactly what we're seeing. And it's part of two key elements. One, we're seeing a really strong proof that consumer demand has been tremendously resilient, but also that routines have returned. And that has guided a lot of the decision making that we make on a day-to-day basis. And as that continues to take place, expect, normalcy, quote unquote, to return.
So, Ethan, curious to know how you think this is going to impact the need for labor moving forward. I think we've all seen, and just anecdotally, if you just try to get an Uber or a Lyft lately, it's like good luck. There's no drivers available out there. So as we see more and more people frequenting these businesses, how are they faring in terms of having the right amount of employees to be able to match some of that demand?
I mean, you nailed it on the head. I think as we talk about how important that in-store, in-restaurant experience is, it puts an added emphasis on how important the staff and employees are within every location. And that doesn't matter whether it's a Starbucks or a Macy's or anything in between. And so that labor piece of the puzzle is going to be really significant. And I think it's going to depend on regions. So in cities, we are seeing this rise of a younger, slightly less affluent base coming in to live in major cities. We're seeing a shift in the suburbs. And so I think a lot of the strategic decisions that are going to have to be made, whether it's supply chain or whether it's staffing, are going to fall on the shoulders of these brands to ensure that that in-store location, that in-store experience is ready to meet this demand that's coming its way.
And speaking of that experience, Starbucks, as you noted in the report, has really always been an experiential place. And prior to the pandemic, we saw fireplaces in fast food restaurants like Wendy's. Moving forward, how do you think fast food restaurants are really rethinking how they're portraying their consumer experience?
So I think it's all about understanding where your audience is in each specific location. So if I have a Starbucks location in Midtown Manhattan that is catering primarily to people before or after work or stopping in for a quick bite in the middle of the day, then I want it to be convenience oriented. And it should be all about how I make that trip as seamless, as short, as painless as possible. But if I have a location in the suburbs, I want to make sure that there's space, that there's a place for people to sit down, open up their laptop, work for a little while, because that's the opportunity that work from home provides. And for a brand like Starbucks or Dunkin' or Panera or many others, that's a customer that's going to be sitting there for a longer period of time, increasing the likelihood of a higher transaction size, several coffees, more food, and a more valuable customer at an off-peak period that could provide a really strong benefit to brands like these.
Based on how things are going right now, if you had to estimate or take out your crystal ball, when do you think exactly we're actually going to hit back to normal, so to speak, or perhaps even exceed some of those pre-pandemic levels, especially as folks are, just absolutely dying to get back outside and to hang out with friends and to walk into a store and see a face instead of ordering everything online?
it's so hard to predict and to speculate. I think the big opportunity for us to really see where we stand in terms of the wider food and beverage and retail landscape is going to be the back to school season. So late July, August. If we're seeing numbers that are in line with 2019 levels or even surpassing them, that's when we're going to have a lot of confidence that the recovery has really found its footing and we're looking back towards growth and improvements. I think that could be coming our way. All signs indicate that we're moving in a really positive direction, but in a year as crazy as the last one it has been, it's very difficult to predict.
All right, Ethan Charnowski, Chief Marketing Officer for Placer.ai, Yahoo Finance's Brooke DePalma. Thank you both for joining us today.
Let's talk about the cost of shipping containers, because it's been skyrocketing. It's something that we've been following here for the last couple of months. Shipping freight rates hitting a new record this week. And of course, this is causing a huge issue for trade. So we want to talk a little bit more about what's going on exactly, what's behind the huge price spike. And we have Patrick Berglund. He's the CEO and co-founder of Zenida. And Patrick, it's great to have you here on Yahoo Finance. I know your company tracks the cost of containers. You also help companies navigate the price spikes at a time like this. Talk to us, just, I guess, explain to us exactly what's happening, why we're seeing such a big price spike here for shipping containers, and also whether or not this could potentially get worse.
Yeah, I mean, first and foremost, thanks for having me on today. I really appreciate the opportunity to do this brief with you. I think it's the fundamentals is a mismatch between supply and demand, right? That's what's causing this. And the root cause for that actually stems like years back, where this industry has been in deep sort of problems for almost decades in order to try and make any money. And through that, you've had these waves of consolidations, mergers and acquisitions, and even in 2016, a bankruptcy, as you might even remember, with Hanjin going bankrupt. And this has led this industry into a situation when COVID hit, the industry didn't have, the infrastructure in place to tackle such a shock. And this started right when, consumers dropped their consumption of durable, non-durable goods, services. Everything stopped in February, March as China shut down. And since then, it's been just events after events, like, Brexit, like Ever Given getting stuck in Suez, whether it's Yantian, shutting down, and these sort of incidents, like the port strikes you've had on the East Coast, right, has created disruptions in these supply chains and have moved the equipment, the boxes, into various areas of the world where there's not necessarily needed, and the same on vessels and capacity, and this has made rates skyrocket.
So Patrick, help us understand how, because you're growing your business, who your clients are and how they use your business to circumvent. I mean, when you look at the average rate was $3,000 for one of these containers in some places, and now it's over $10,000. How does your client use that information or your company to their advantage?
Well, yeah. So first and foremost, they need to understand where the market is at any given time in order to not be exposed to the risk of not getting shipped, which is one of the key challenges today, right? So whether you pay actually $2,500, $3,000 or $10,000, the problem is to get shipped. And this is part of the problem. Like companies working with us, anything from Nestle, Unilever, Louis Vuitton, any type of industry, whether it's chemical companies, pharma companies, they all feed in their freight prices to our platform, and we aggregate that to create these indices for the different trade routes around the world. And for them to understand why is there such a spread in the market, let's say from $2,500 to $13,000 on the most extreme, if you look at Asia to Europe, and then trying to navigate and understand where can they sit in order to have goods moving either on the spot market or on the contract market. Right? And this is the conundrum they're facing today, because you have extreme market conditions. Like Home Depot went out the other day or today and announced that they're chartering their own vessel in order to secure the flow of goods over on the Trans-Pacific into the US. And our customers need to understand our budgets. Are they doubled? triple, because we're talking about rate increases here on Asia to South America of almost 800% given compared to a year ago.